I had the No NAV Erosion CEO back on my channel. That is what I call him anyway, Si Katara from Tapp Alpha Funds. You probably have heard of his funds like TSPY and TDAQ that have been performing extremely well. We're going to talk all things weekly dividends, future income products, and the 3-month performance of TDAQ, which has been amazing. So I hope you guys are ready. Let's get into it.
Spencer, great to be with you again. It's been since previous to your wedding and your honeymoon, so it was exciting to hear about the trip that you took. And welcome back. Like you mentioned, when you left the country, the market went down. So thank goodness you're back because the market's going back up again. So, but welcome home and congratulations.
Thank you. Thank you so much. We have some great questions. I've created some, we've pulled some from the audience, and so people are going to get what they're asking for. But we want to start off by saying congrats on 3 months of TDAQ trading to this day, correct? It
To the
started October
day,
4.
3-month anniversary. Yeah.
Amazing. Amazing. But we'll zoom out a little more and we'll talk also about TSPY. Can you give viewers a little breakdown on these funds who may not be familiar with them?
Absolutely. So I find beauty in simplicity, and both funds are very simple conceptually. So we'll look at TSPY. It just owns dollar for dollar shares of the S&P 500 through SPY. And then every day, all we're doing is selling an out of the money covered call that expires the same day. And then day ends, overnight exposure is uncapped, and then we do the same thing the next day. And the only time we won't do dailies is simply if we're doing a risk mitigation or defensive strategy, but that's it. Own the shares, whatever the underlying security is, and then write an out of the money 0 DTE covered call. And it's not sexy, but it works. And it just adds up little bits of premium every day. And then that's where you sort of see the growth trajectory of what we can deliver for both growth plus income, which is sort of a special new category, which we're really trying to sort of be a part of. So that's what we're doing with TSPY. And then TDAQ, same thing, QQQ, 0 DTE strategy on top of the Qs.
Amazing. And yeah, the performance speaks for itself. So there's, even if it isn't, the flashiest thing, performance is what I like to go off of. I'm not a flashy guy myself. But that's excellent. So we did just hit 3 months of TDAQ's performance. I wanted to get your thoughts so far on the fund. Is it as you expected? Give us some feedback.
It's interesting. Like the main difference between TSPY, which we ran for a year before we were even able to launch TDAQ, is the volatility of the Qs is higher. So it actually is interesting because there's just a little bit more premium opportunity out there. And the bad analogy that comes to mind is, have you ever gone to like a carnival and there's the thing where you go to win the stuffed animals by shooting baskets? And they kind of rigged the game a little bit because the basket's almost exactly the same size as the ball, which is really hard to hit. Like TSPY and the S&P 500 is kind of like that. You can do it, but it's just more challenging, where TDAQ and the Qs, the hoop is just much bigger. You got more opportunity. You got a bigger strike zone to actually go hit and collect premiums in a way that's going to meet your goals. And so that's been the biggest pleasant surprise. And we've been sort of hitting the mark where we're distributing about 17% for TDAQ, and we're distributing about 14% for TSPY. And the relationship between those two numbers is almost identical to the difference in the volatility of the two underlying securities. So it's really been working to plan. And the coolest part has been it's the same underlying technology that's driving both funds.
That's absolutely amazing. And I think that's a good analogy. I'm a fan of basketball, so maybe it just makes sense to me, but it is really impressive, the performance that we've seen. And I didn't know that the yield was that high. That's very, very impressive. Now, is that maintainable, or do you think that's just in the current market that we're in?
I think it's something that can be relatively consistent. Again, we can't guarantee future distributions of what they'll be,
Of course.
but as we did with TSPY, it's been 15 months now of TSPY, and we've been really on the money for about 14% month over month. And if you see the distribution curve, it's basically been that. It's funny, like you'll see the distribution, and it kind of went down a little bit in April, but it wasn't because the distribution percentage changed. That stayed. But what changed was the denominator of the market, because the market went down a bit, so your distributions go down a little bit. So
Interesting.
we've been able to be pretty consistent with that. We're going to do our best to do the same with TDAQ as well.
Amazing. And yeah, so I have the chart pulled up. We're looking at a total return as of today. I think this is live, 9.63% for TDAC since it did start trading. Yeah, September 4th.
Yeah, 4 months to the day, and if you can, would you be able to go, and we can edit this part out, but go to select symbols and add the NASDAQ 100 to it?
But yeah, is it just Q? Is it QQQ?
Do NDX. And
There
yep,
we
there you go.
go.
Okay, and then just do
Here we'll
September 4.
go. Oh yeah, we'll do September.
Awesome.
Wow,
So this is
that's outstanding.
a really good illustration of what the strategies were designed to do. So if you kinda look at the left-hand side of the chart, right, they both have the same starting point. And the long position is gonna sort of track what the Nasdaq does. But you see every day, the 2 lines kinda diverge a little bit more and a little
Mhm.
bit more. That's exactly illustrating what the strategy is meant to do, because every day we're just harvesting little bits of option premium that start to separate the lines. And so if going as designed, you start to see as we get out further to the right, we've been able in 3 months to add, I think, exactly 150 basis points of options alpha just from the option
Wow.
strategy itself. So about a 0.5% per month. And again, we don't know what's going to happen in the future, but if we can
Mhm.
continue to do this, it adds meaningful differentiation between the total return performance of this fund versus its underlying asset. And that's exactly what the strategy was designed to do. That's what we built it to do for TSPY, what we want to do for TDAC. And then we want to take the same engine and apply it to different underlying securities or indices to scale out
Mhm.
this idea. But that's it. It's 0 DTE options on top of whatever the underlying security is to occupy this growth plus income capability. And if we can do this at scale, I mean, we're gonna hopefully change the game for what the ETF market's able to deliver.
This is astonishing to me for a number of reasons. What really blows me away is the fact that even in down points, right? Like we had a bit of a drop at this point, it still holds up, which is so unrealistic for what we've seen with most income ETFs, especially single stock. When you start putting it up against, the underlying, this is where they really start to change. And you've seen the underlying run, but you're so capped depending on the option strategy that you don't get that run back. But it not only does it maintain it, but it consistently outperforms. And like you said, it's still growing. So, wow,
That
that's
and those
really
like
really impressive.
for the options, covered call folks out there too, the biggest like danger zones in these graphs, you see the V shape. When it goes down and then
Hmm.
pops up, it's the pop up that is very dangerous for covered call strategies because a lot of times you'll get
Interesting.
capped. You'll take all the downside, but then you get capped when you're recovering. But that's the beauty of
Mm,
0 DTE. It gives you the best chance because it's so short that you don't necessarily cap yourself in the same way that you would if it was a 30-day position where,
mhm.
it goes up quickly in a day, but your 30-day position, you're stuck. So that's one of the most powerful capabilities of the 0 DTE strategies and why you're able to see this kind of performance even where there's V-shaped curves in the graph.
So we have seen a lot of zero DTE funds. I shouldn't say a lot. We've seen a few zero DTE funds before, and they haven't really had this style of performance. I've been tracking them for since their inception, really. So, what is happening on the back end? Are there any micro adjustments or things that you guys are doing differently that is changing these outcomes?
Execution matters a lot when you're looking at strategies like this. So, 2 things. 1, we were one of the earliest 0 DTE funds. Like, same day options didn't come out until late 2022, and then ETFs didn't really catch up until 23, 24. And so we came out in 2024 and have been doing this, but the execution side of it is really what matters most. So, one of the reasons potentially is some strategies just do a really mechanical execution where they'll just write a call at the same time of day and they'll do a similar kind of delta or a similar out of the moneyness. We don't do that at all. Ours is very dynamic for a very important reason. And one great example I like to give is how could you write a mechanical call the same distance away from the market on the day that Jerome Powell is speaking because of a Fed meeting and there's an interest rate decision? So you wouldn't want to do that because if the market rips as a reaction to it, you could get in a lot of trouble. So for us, we take a very dynamic approach where, we call those tier one events. We will not bet on what side of the market is going to go up or down before the event. We let the event happen. we let it pass, we let the market digest it, and then with the time remaining, we try and hit our income target after that. Way easier to manage risk that way. And we do that all the time. And the other thing is I mentioned the fintech that runs both funds. It sucks in all this data in real time and processes it and says, hey, what's the ideal risk versus reward for what you can get paid for a particular option premium based on this huge data set? That's very powerful and dynamic for executing and when to execute and where and how to pick your strike. So it's a very dynamic strategy. And then the other thing that I learned in coming into this industry, um, all of the trading that's done by ETFs is typically like done by email and spreadsheets. And so just to do one trade to get all the parties aligned, from custodians to executing brokers to clearing agents, it could take 1 to 2 hours just to get one trade kind of fully processed. We automated all of that. And now we can do that in a matter of seconds. So that gives us way more flexibility where if the
Hmm.
market's running, we can make a change and actually get out of a position or take a second bite, depending on if we see things that are in or outside of our strike zone. So that dynamic capability is a game changer when it comes to executing zero DTE strategies.
Wow, amazing. So much knowledge shared already. And I think that was the second question.
More to come. I love it.
Yeah, more to come for sure. And we may have touched on a couple of these things. So if you want to skip any of these, let me know. I think maybe reiterating the zero DTE options. So you use them specifically for all of their bonuses.
Yeah, and
Okay.
there's three big kind of game changers for zero DTE. When we're deciding how to build the ETFs, we actually looked at 30-day versus same day. And the first big reason was if you take a 30-day option and you write a call it 25 delta, just to make it apples to apples, and you get X dollars in premium. Versus if you take a 0-day option, you write it at 25 delta, and you just do one of those every day over the 21 trading days, and you added it up, the option premiums you get for doing the 0-day is 4 to 4.5x what you would get for a 30-day. The risk adjusted returns just alone is a game changer. There's just more option juice when you do it daily. And I was like, why? Why is it so stark? And there's two reasons for that. Number one, if you've ever, like I do, like a nerd, look at options curves, the last day, the theta curve is really what we're taking advantage of. The steeper the slope, the better it is to be selling them. So we take advantage of the steepest part of the slope every day versus a 30-day, you only kind of get a big swoop and then a steep at the end. So that's one of the reasons. And the second reason is 0-day options are now more than 50% of all the options traded on the S&P 500. They're wildly popular. And so when you're from a supply demand perspective, like people are buying them at a more expensive rate. Therefore, I'm not a fan of buying it, but if they're expensive, I'm a huge fan of selling them. So putting those things together. That's kind of point number one. Point number two, we're true zero DTE, meaning we write it in the morning and then most of the time it expires same day. Guess what we skip? Overnight risk with the options position. So like we have our long position, and then when Nvidia does earnings or there's a big aftermarket event or there's something that happens overnight, like our option position is uncapped. So you can catch all of it. And then or the next morning, like there's a CPI report that's favorable and it goes up before the market opens. We catch all of it and we don't have to manage the option risk when you actually are doing true zero DTE. And so that's really helpful to be uncapped overnight and on weekends. And then the third reason, you just get more at bats. You have one 30-day, you get one shot to get it right. But with 0-day, you get 21 or 22 swings to actually change what your strike is every day. And the bad analogy I use is if I'm flying from New York to LA and I have a 30-day analogy, I'm pointing my airplane to the runway at LAX and I take off and I'm on target, but then a huge gust of wind comes or a thunderstorm or something unplanned, it knocks you off course. There's nothing you can do in order to course correct to get to where you wanted to go. But with 0-day options, you get 22 chances to sort of course correct, and it just gives you a much higher chance or probability to land where you intended to land. So That those are the 3 big reasons why 0 day was the right tool for what we were trying to do. And again, the goal of the funds is growth plus income. We wanna try and mirror and capture as much of the underlying growth as possible, but also generate a meaningful revenue stream in addition. And those are the 2 components that, for people that know my story, were the game changer, where I needed to grow the nest egg, but I also needed to pay the bills and make ends meet. This
Hmm.
was one way to sort of deliver both outcomes in one package.
That's phenomenal. And for someone like myself who I invest in both income and growth, it's really cool because I'm a big fan of drip. So I don't live off my dividends currently, but you have the ability where it's hard to find in the income ETF space because you never know if we're going to have a fund dropping substantially. But when you have
Mhm.
long-term trust, I should say, when I have long-term trust in something, and you see the curve that it continues to go upward, then you can truly utilize drip because you're buying at the lowest cost, depending on the performance, of course, at the lowest cost at that time. And so it's a really cool strategy. I think that's awesome. And I think your explanation of it is really important for investors. So
You
next
sort of
question. Yeah,
you
no, go
sort of
ahead.
nailed it too. I'll back you up on that. Like, it's, it's sort of an idea for long-term investors. When you have something that you believe is gonna rise over time, and like being an S&P 500 investor, I've always been that.
Hmm.
S&P beats 88% of fund managers. And so if you already have conviction in the underlying, like, we're not convincing anyone to get new conviction in a new underlying. Like, you already believe in it, like, you get that exposure, you're just adding these new features to it, including 14% tax efficient income, including better risk adjusted returns, including tax efficiency that you wouldn't get if you tried to execute this on your own, which for me also, I can share that, was a game changer. So that's kind of the idea. It's like I'm such a engineer by trade where I want to minimize variables, and
Hmm.
I'm minimizing all the variables with this. It's just I love the S&P and I love the Nasdaq and I would have bought them anyway, but I
Hmm.
wasn't getting the full potential out of them. And so by doing this strategy on top, I feel like I'm getting much more out of that conviction that I already had.
Amazing. And you're also helping a different audience than someone that doesn't want to go in and sell a small portion of each, position every single day, which is me. I would never want to do that even in retirement. So that's amazing. Into our next topic. I know everyone wants to know information that's classified that you can't speak on, but specifically with zero DTE options, would this work on different underlying assets? Some examples I had would be cryptocurrency, gold and silver, maybe the Mag 7. Is that a possibility?
Yes, absolutely is. And the main idea, and that's what I love about the strategy, it's one strategy, but you can apply it to almost anything. And the main thing to think about, number one, do you believe in the underlying asset? If you already have conviction in crypto, this is just a new dimension to it because it adds an income component to it. So that's number one. And then number two, the suitability of it really depends on your risk profile and the volatility of the underlying asset. So as I mentioned with TDAQ, it's more volatile than TSPY's underlying. But that volatility is good if you're harvesting that volatility and turning it into income. So crypto is great to generate large amounts of potential option premium. Mag 7, same idea. You're getting a lot of the AI boom if you believe in the underlying, but that volatility, the up and down, is what you can actually use this strategy to like magically turn it into income. So 100%, this is really something that can be put on almost any underlying security, just keeping in mind your conviction and your risk profile for what kind of comfort you have for the ups and downs that you're going to go with those underlying securities.
Awesome. Wish you could like patent it or something like that to where no one else could use it. But I guess that would
Yeah,
be
I mean,
detrimental
the
overall.
strategy itself is, and I'm sort of one of those guys that's very like transparent. I will share everything about it, and then if you can execute it on your own, go do it. We've
Hmm.
built a bunch of like really powerful tools that help us do it. I think better than anybody else.
Hmm.
Um, and then the other thing is the tax purpose of it. Like doing it inside of an ETF is potentially way more efficient than if you actually do it outside of an ETF. So maybe another ETF provider can come and do it, but you're going to have to race us in the
Yeah.
game on the road.
Well, and we've seen them, and I won't knock the perform. Some have been okay, but they don't stack up, with what we've seen. So it's really impressive. Speaking on, some of the competition and different dividend formats, currently TDAQ and TSPY both pay monthly dividends. Is there a chance in the future that we'll ever see these convert to a weekly structure? And would that affect the options at all?
There is a chance. So, like, one of the things we love to do is listen to what investors need and want and the why behind it. And people have made compelling cases for why weekly makes sense for them. So, yes, I think in the future, will support weekly distributions. Um, with these products specifically, they probably will stay where they are, but there
Hmm.
may be related products downstream that switch to weekly. And the reason is we sort of set an expectation, and I like to keep it. So people that love weekly are retail investors that like the frequency and then have investing and also spending needs that might correlate to that. The people that don't like it are the other side of the market that we support, which is advisors. If they're getting weekly sort of distributions that they have to manage, they don't like it. So that's the trade-off where one thing helps one group and it hurts the other. So for us, it makes more sense. Okay, we'll just make two separate sets of products. So things like that we're exploring downstream. So keep your ears peeled. But yes, definitely, the weekly has been something that's been very popular, and something that we want to make sure that we can help support, especially if there's a need out there in the marketplace.
Amazing. And that's the cool part that I love about these interviews is we get that insight as to why, because we don't think like about anyone else, really retail. We focus on retail. So advisors and whatnot, that does make a lot of sense. Ooh, love that. So on to a touchy topic with a lot of issuers in the income space, which is the NAV erosion, NAV decay. When it comes to the net asset value, for those that don't know, the NAV remaining stable, how does that work with the distributions? Because we spoke on this, and so the distributions are paid from the NAV. How
Mhm.
does that work with the influx from the premiums?
Yeah. So the high level thing to remember, and it's interesting because people like always try, sometimes you hear people, oh, I need to get in before the distribution comes out. One thing that's really important for everyone to understand is the distributions come straight from the NAV. So if you have a ETF that's worth $1 on Tuesday and Wednesday is the X date and you pay 10 cents, on Wednesday the NAV is going to be 90 cents because you took out 10 cents and paid everybody out. So there's no free money really in that. It's just really a timing thing. So that's first and foremost most important. When it ties to NAV erosion, different people identify it and define it different ways. I try to think of it very simply. NAV erosion, by the way that I like to define it, is if a fund is distributing more than its total returns. And if you use that test, so one example is if there's an ETF that returns 20% over a year, but over that same year, it's distributed 25%. So 20% came from either the capital growth and or the option premium collected. It's 20%. Where does that extra 5 come from? That comes from the original principle that you put in. So that's one of the easiest tests that I like to run when you're trying to figure out, does this have NAV erosion or not? And a lot of times people get confused where they're like, well, there's a yield number of 30%. First of all, it shouldn't be called a yield. It should be called a distribution,
Hmm.
because a distribution in theory can be any number, whether it comes from returns or your principal. So just keep that in mind.
I didn't know that.
Yeah, that's really important because a yield implies it's earned and you're pulling it out. But the reason the SEC makes you call it a distribution rate is because it's not necessarily earned. So I'll give you an example, where let's say you just had an ETF. This should never exist, by the way. This is just for illustration purposes. But if you had an ETF that just took all of the investment and it put it in a money market in cash, it could theoretically have a yield of 50%.
Hmm.
So you could actually take that cash and over 1 year distribute 50%. Your NAV or what's left will be half.
Hmm.
And then it'll do the same thing the next year. Your NAV will be half, but your distribution rate's going down. So there's no yield because it's not earning anything. It's just giving the money back. And
Hmm.
you can label that as a distribution. So that's a good illustration just to be wary. And the best test is just apples to apples, total returns versus distribution. If total returns are less than the distribution, you're probably going to have NAV erosion.
Okay. Man, that's a really good breakdown. It makes a lot of sense, and we're in this space of hyped up ETF investing, especially with a lot of these high yield products that are just, yeah, distribution rates. I've seen them hit 140%, and it's hard for new investors to come in and go, "Wow, I want that one." Right? It's the highest yield. Why doesn't everyone buy this? And then you get the explanations behind it, and you're like, "This is why." Yeah, like you said, it's not. There's no free money. Everything
Mhm.
has the risk component as well. Yeah, that's amazing. And so when it comes to TDAC and TSPY, is the goal to maintain a specific distribution rate, I should say, um, for the funds individually? And would a bear market see a bigger hit to the NAV, or would we see a bigger, I should say, a drop in the distribution rate if we did see, say, a 20% pullback to both indices?
That's a perfectly phrased question because that is exactly the trade-off. Are you gonna maintain your NAV or are you gonna maintain your distribution? The way we tackle it, if you look back at TSPY in 2025, April 2nd, when the market tanked and it was like 18% drop,
Hmm.
our distribution rate, the percentage stayed the same. So we stayed at 14%, but the absolute value went down because the market went down. So, it dropped a couple cents, but it was for a short amount of time. If that was sustained, then we'd have to make a really important strategic choice. Are we going to keep trying to be consistent with that distribution percentage? And if we're unable to fill it with more option premium or from some other additive bucket, and we've leaned to maintaining NAV for Tapp Alpha funds is more important. Now I understand that income and consistency is critical, especially as you're getting into retirement or you're relying on that income. But for us, it has to be sustainable. And if we have to chip away at the nest egg to do it, I would rather maintain the NAV and let the investor take the power into their hands to say, I need more cash. I'm going to actually actively sell shares in order to get the cash that I'm not getting rather than the fund manager make that decision for you. So that's sort of the direction that we would go in a prolonged, sustained downturn where we can't replace the capital growth with options income to sustain that level of distribution. But that is a trade-off. And in short terms, like we saw in April, we were able to sort of do both, give the consistent income, but then continue to grow the capital appreciation, and NAV came back over time.
Amazing. That's such a good answer to a very prominent question for a lot of active ETF investors right now. So I can already see the comments coming for that one. Jumping to our next question. Why would you choose? Well, we kind of answered this one. I'll say it either way. Why do you choose income ETFs and income products over growth if growth typically outperforms?
That's also a great question, and our sort of position is, even you look at the name of our ETFs, it's sort of the SPY growth and income, daily income ETF. So we're trying not to choose between one or the other. We're actually really trying to take a balanced approach to both. And there's trade-offs. When you have high income, you get less growth, and more growth, you have less income. We sort of are trying to hit this middle ground where we're delivering kind of the growth of the nest egg and the NAV appreciation, but still distributing meaningful income. And one piece of feedback that we got too is like, especially on the advisor side and folks that are more conservative, where they're like, I only need 8%. I don't need 14. So one of the cool things that we were able to do was create tax efficient distributions that say, oh, if you don't need 14, you can take the extra 6 and tuck it right back in through a drip, and it's not leaky from a tax perspective because of the efficiency of the distribution. So that's how we sort of check both boxes for people that want lower distributions versus people that want higher. And that's why we landed on sort of 14% targeted for TSPY, and then seeing that TDAC can actually support a little bit higher level of it and keep that same um, measure of balance.
Interesting. Wow. This is probably my most knowledgeable interview that we've had yet, which I appreciate. Investors really appreciate it too. So when we jump into the conversation of implied volatility, I think we did touch on this one already. So TDAC should, you can't say that. TDAC has had consistently higher implied volatility, creating a higher yield, and that's something that you guys anticipate that?
Yeah, in looking at it, so I ran a lot of numbers to do the comparisons and sort of see where things sat before we actually did our distributions and designing the product. And that is it's by design. We kind of wanted to keep the consistent theory, but what can actually this new underlying security deliver under that same investing theory and strategy? And because of the IV, I mean, it is one to one. Being higher, there's just more option premium to potentially distribute, and still able to sort of support the same balance between growth and income. So we were able to surprisingly support a really high. Well, some people don't think it's high because of the 50% distributions, but for the marketplace and sort of the low to moderate risk investors that we're sort of serving, able to deliver what I think is a pretty high, attractive distribution rate, but still support that growth side of the equation as well.
And I think it's interesting too with all the newer investors in this space that are used to these high yields. When I first told my father, who's an accountant, about a stock I was looking at that had an 8% yield, he was like, "It's got to be a scam. Can't do it. There's
Exactly.
no way." And this
There's
was
no
this was
way.
7 or 8 years ago now. And now I talk to him about how they're able to do it, and he's blown away by it, but he's more old fashioned with his investing strategy. But I remember that so distinctly. And then coming into the ETF space and you see high yields, and it sometimes we do kind of give it a bad rap because if you have something that says it's a distribution rate of 70%, people are going to look at that and think there's no way. There's a catch to it, of course. So it is really funny that what we now see as being I call them mid yield, like anything from probably 10 to 20%. Because if I say high yield, people are like, this isn't high at all. There's fund
Right.
5X. And I'm like, but there didn't used to be, like we may have a 200% distribution rate one day, but it doesn't mean it's going to be good or it should be, factored in as a high yield. So
That's
it's interesting how the space has changed over the years.
Yeah, and you raised such a good point because you see this one number, but that one number isn't the complete picture. And
Hmm.
that's why the stuff that you do is really important in the sort of the creator, resources because you guys help crack open the box to help investors understand that there's maybe two, three, four dimensions to look at before you make your decision. And it's about transparency and education in order to empower people to make the right decision for themselves. And one number isn't going to do it
Hmm.
on the top of any tin.
Definitely. That's why you never invest off of what you see on Twitter because it's
Exactly.
usually one sentence. It's like, nope, don't follow that. Oh, excellent, excellent. So diving a little more into the option side, how did the strategist decide what options to write? For example, credit spreads, protective puts, etc. And what tools are they using, or I should say, are you using to not predict the market, but to analyze the market in order to make those decisions?
Yeah, that's a really I love it. That's an in the box question. Open the box and let's look inside. So, how do you make those decisions? One, you're right. No one has a crystal ball to predict the market. But what we do have are tools that can snapshot the market now and give you little hints as to how you manage risk. So to the first question, how do you choose like what tool to put in? Do you use a credit spread, just a covered call, or a protective put? For us, we use two factors to decide if we're going to spend the money to buy the credit spread or the protective put. Those two factors are volatility. So if VIX is really high, so like in April, it was over 30. So if it's 29 or higher, then you got to look to say there might be some big swings that happen and um, you might have to protect your position. So we just use those two positions, credit spreads. Um, you buy the call, that's protective, that's catastrophic insurance to the upside and a protective put is catastrophic insurance to the downside. So we use volatility plus momentum. What direction is the momentum going? And those two indicators that we pull in our real-time data will tell us, yes, this is appropriate to put these tools in. How do you pick your strikes? So for us, it's multiple factors that come in. So delta is important, momentum is important, RSI is important, MACD, VWAP. So there's all these acronyms, right? Doesn't matter. What matters is there's a system that scrapes all this stuff that gives you hints as to what the market is doing. And one of the most important hints is what's the underlying options landscape look like? Because if there's a particular strike that has huge volumes on it, one way or another, either puts or calls, if the market gets close to it, that's going to have an impact of what might happen coming soon You don't know if it will, but at least you can protect yourself and manage risk that way. So we built all this tooling after April to help us see that. I call that tool my fish finder, where you can kind of see what's going on under the surface. And
Hmm.
that's been really helpful to deliver the kind of performance that we've done in TSPY and also for TDAQ and any future funds as well. So data is important, how you process it in real time, and then what are the indicators you use in order to decide, where's the risk level? Is it risky or is it safe? And is it worth to spend to do, put in some of these tools that we're able to use in the toolbox?
Wow. To me, that sounds very stressful. So I really like that these ETFs are available, so I don't have to deal with with all the underlying stuff. That's amazing. It is really cool seeing the back end stuff because I don't know if I feel like interviews are more common now than they used to. Because I used to just listen to like what earnings calls and whatnot, but you never really got the full understanding and put a face to the company and everything. So absolutely phenomenal. So just a mid thank you again for coming on the channel before our next question.
It
Um,
is stressful, and it's great to be here and talk about it too. It's almost cathartic for me to like share with you. Like, yeah, there's certainly stress to it, but what's actually alleviated a lot of the stress is just being able to see. If you can see through the noise, and you're never gonna see a crystal ball, but at least you see kind of hints. Those
mhm.
hints give you enough to protect or to go based on what your strike zone is. And the only question we're asking as portfolio managers is this in our risk profile? Yes or no? And if it's in the box, do it. And if you start to drift out of the box, protect it. That's it. And having all the data and information is really helpful to help us make those decisions.
To our next, we're back to NAV decay. There were a lot of comments about NAV erosion and how it works and whatnot. Um, let's see. So, NAV erosion or NAV decay is a common fear amongst income investors. Is NAV erosion specifically a threat to every ETF that pays a distribution? And do the strategists determine the levels of NAV erosion or NAV decay specifically? Like, I don't want to say who do we have to blame, but if we see a fund that is performing really well, paying out high distributions, and then we see a complete switch where maybe the market flips a little bit and all of a sudden it's significantly underperforming, would that be solely on the strategists who are writing these options?
It it's on let's break it down what you can and can't control. What you cannot control is the market.
Hmm.
There's just no doing it and there's no predicting it. But what you can do is control how you manage risk and what you do and how you react to the market. So, in certain cases, if it's just mechanical action where nothing changes from the management perspective, but the market does something, and it turns out being NAV decay, if that portfolio manager says, "Yeah, we're just going to do a mechanical thing, and this is the expectation," then nobody's at fault, but they're doing a mechanical thing. If the manager says, "We're gonna change based on what the market does, and here are the expectations," and then they do that, then they're staying within their guardrails that they put in the prospectus. So, you can't control the market, but you can control what you do with it. The one thing that's really interesting about distributions, and that's why I don't call them yield, that's actually something you can control as a portfolio manager. So that's a choice where you can distribute as much or as little as you want based on whatever criteria you deem fit. So if you as a portfolio manager are consistently distributing more than the actual investment is returning from a total returns perspective, you are deliberately um, going to be shrinking NAV over time. And that's okay. That might be useful for some people that need the income. But for people that are trying to avoid it, that's one thing to be very wary of. And that's why that test we talked about earlier, look at total returns over a period of time, over a year, and look at distribution rate. And if total returns is less than distribution rate, that fund probably has NAV decay. And that's okay in some cases, but just knowing going in eyes open to what that investment will provide is really, really important before you put your chips into that bucket.
Interesting. So if we flip the script on that question a little bit and we said it did the opposite, say the fund, the underlying does super well, everything's moving in upward momentum, you could technically decide if you wanted to distribute more or just to leave that in the NAV. That would that also be an option?
Yep, and it could be an option. And it also depends on the characteristic of the income that comes that way. So, one interesting thing about ETFs, and this is why we built TSPY and TDAQ owning real shares.
Hmm.
If you have a 1256 contract, which a lot of these options are. So that's what we use. And you make a ton of net positive premiums over a year. Because it's an ETF, you actually have to distribute out 90+% of what you actually harvest in the market. That's just an ETF rule. So from that perspective, you have to do it.
Okay.
That's why synthetics are hard, because guess what? A lot of the synthetic option ETFs, they're built using options and 1256 contracts underneath. So even the capital growth is being synthesized with sort of an option, synthetic options. That's why you'll see in December these huge distributions, because any synthesized capital growth that happens has to be distributed before the end of the fiscal year. So
Interesting.
there are some really nuanced rules about that. So for us, we really wanted to own physical shares because of the growth plus income piece. So the growth piece, like, we can keep all of our capital growth in the value of the SPY shares or the Q shares even after year end, and that can grow and compound over time as capital growth. So you don't actually have to distribute that. And that is a really powerful differentiator for what we built versus, I think, maybe some other strategies to implement, 0 day option strategies.
So many little pieces go together to make everything work. That's awesome. And touching on the tax efficiency, people often ask, what kind of account should I have? What should I be doing? And we don't give financial advice, of course, but it's interesting that there's not a whole lot of knowledge on the different kinds of accounts. So I wanted to ask you specifically, um, if you can even touch on this, would it be, I don't want to say smarter, would it be would it make more sense to hold these both TSPY and TDAQ in a Roth IRA versus a regular brokerage? Is there anything that, I'm sure it would be situational, but I wanted to get your opinion.
Yeah, it's situational. I can't speak to other people's tax situations from that perspective, but I can maybe
Mhm,
speak to the subject by sharing my own. So for me, when I was actually doing the strategy, so I own SPY and I sold 0 DTE calls in my brokerage account, and I got my tax bill at the end of the year. It was brutal. So it would have been way better to do it in a Roth.
mhm.
And the reason it was brutal was because there's this thing called straddle rules. And so it hurts. There's two sides of value. There's the option premiums, and then there's the capital growth of the underlying. The option premiums, I was using equity options. So that's just short term ordinary income. Fine. The thing that really hurt was the underlying SPY shares. Um, the capital gain clock pauses when you do a covered call. And again, I'm not an accountant, do your own tax research, but for me, this is what happened. And so if you buy SPY shares and then you're writing covered calls on them every day, even if you own those shares for more than a year and you sell that share for a gain, that gain is short term, not long term capital gain, which is brutal. So both
Yeah.
sides are short term cap gain. Now, fast forward to, so when TSPY, we finally launched it, I sold all of my SPY shares and replaced them all with TSPY shares. And what was cool about that in my mind, because I'm an engineering nerd, I basically had the same number of SPY shares. They were just wrapped in the TSPY ETF.
Mhm.
And now that whole tax situation was way better because the option premiums, I'm now using 1256 contracts. So that's 60% long term, 40% short term cap gains,
Mm.
even for short term option premium. But the other thing that is just a game changer was the underlying shares. Instead of being considered short term cap gain, because ETFs can do these thing called in-kind redeems, like, if I sold a share of TSPY that I held for 18 months, instead of that short-term situation, the fund hands those shares, the shares of SPY, back to the bank in kind. There's no sale. Therefore, the short-term consideration gets wiped away, and
Wow.
all the TSPY investor has to pay is deferred long-term capital gains on the NAV growth of the
Mhm.
fund. So it's just way more tax efficient. So I'm excited for end of year 1099s this year because I'm going to get something that's way better than what I was doing back in 2022.
Yeah, much better than the giant bill. Yeah. Tax season, don't remind me.
I know, but hopefully this will be. That's one thing we don't really lead with is tax efficiency, but we can't predict, right? Because the tax categorization, it has to go through the full year before
Mhm.
the fund accounting can basically assign tax classification to it.
Mm,
But I can share last year's tax classification for 2024 was hyper efficient. It was
mm,
17% qualified dividend from the SPY dividends being directly distributed out, and 83% return of capital, which means there's
amazing.
no tax hit at that point. So for me last year, it was fantastic. And knock on wood,
Mhm.
we've been managing it the same way. We'll see what the classification turns out to be come January.
Excellent. Wow. That's really cool to hear. Yeah, your experience on it too, because that's yeah, taxes. Not a fan. Not a fan
Yeah.
myself.
Learn the hard way. And the funny part, this is, cut this out if you want, but like when you do it in your own account, the brokerage statements are gigantic because of the way that they manage the options and the whatever. It's too much. With an ETF, you get a nice 1099 and you're good to go.
It's much better, and I'll leave this in. I think people will find it interesting. So, Sai, I think I have 6 or 7 different accounts for YouTube challenges, right? For everything that I've done, from buying all the weekly payers to tracking the, the popular monthlies. I have so many accounts, and I used to do my own taxes, and it is horrible. Even remembering the logins is bad enough, but no, we won't go too far into that.
Too
Our
much.
next question. Oh yeah, it's terrible. Daily dividends are talked about all the time. It seems like a pipe dream at this point. We've seen some ETFs, that I wouldn't say they've tried. We've seen, Prospectus launched with the idea of a daily ETF. Is this even a possibility?
Great question. I think it is a possibility. The burden falls on the custodian. So in our case, we custody with the US Bank and we work with them, so we have distributions monthly, but we
Hmm.
stagger them. So TSPY is first week of the month and then TDAQ's third week of the month.
Which is
Thank
brilliant,
you.
by the way.
And it was one of our investors. Thank you, Michael, for sort of suggesting that. And then we validated. And people were like, that's really cool because I kind of get a virtual paycheck if I own both funds.
Hmm.
Um, but so I think it's possible. But like whenever we do distributions, we have to work with our custodian to get them the distribution number on the deadline that it's due. And so this deadline would now come every day, and it's a ton more overhead. So I think it is possible. The thing I would love to learn more about is the why. Why would they need a daily distribution that you can't actually cover a weekly or monthly? And so that's the main driver for me. Conceptually and technically, I think it's possible. The main
Hmm.
question is what's the driver for it?
All right. Well, let's ask the audience, anyone watching, let us know in the comments if there's a real reason other than just simply wanting it, because that's what I've heard of mostly, is people just think it'd be cool. But yeah, I'm not sure if there's a maybe in some instances, but good point, very good point. All right, our last question that was written by me, and this is it's a joke, but still we'll say it. Would Tapp Alpha ever consider teaming up with Spencer Invest to create a 5 weekly dividend suite of funds, each paying a different day of the week to then give daily dividends?
Spencer's daily dividends, the double D's.
We
I
get
love
I
it.
don't know what would even SPNC or something like that.
That's a cool ticker. We got to see. You got to go grab it now before somebody else does.
Yeah,
Um,
see, now they got
you
my
know,
idea.
so it's interesting because like you know me, like I didn't come from finance or ETFs, but
Mhm,
like we were able to build one, and the only reason that we were able to do it is because like the guys at Tuttle Capital kind of took me under their wing, and they're like, "We'll show you how to do it. We'll get you connected to everybody. You interview them, see who you want to work with, and then any questions you have, come to us while you're getting it launched." So like we wouldn't have a fund if Tuttle didn't actually help us do it. But if you ever do want to do SPNC, you come to me and I will get you introduced to everybody because you could actually launch your own fund. And I'm only half joking, but like honestly, ETFs right now are exploding in
yeah.
demand, and we need great humans to come and join the industry too. So if you ever think about it, let me know. I'll get you connected. You can meet everybody if you haven't already met them already. And it's just honestly, it's been one of the most rewarding experiences of my professional life to be able to do this, interact with folks like you, talk to investors, like learn the stories as to the why behind there's a need for these things. And
Mhm,
you think about like there's all sorts of ways to make a living, but doing it in a way that foundationally impacts how people live their lives and the quality of their lives and the things that they're able to do, that is one of the most rewarding things about this. So if you ever think about it, please don't hesitate to call. We will get you connected to all the right people.
All right, I'll keep that in mind. There's low chance, but we'll see. Maybe one day. I like exposing a lot of the yeah, like the hidden retail secrets and whatnot, and helping on that end, but also showcasing funds that are winning. Like I'll just put it that way, showcasing funds that are doing what they're saying and aren't hiding behind, massive influencers putting all this stuff out, being paid. I really prefer these kind of conversations really showcasing to retail who don't have the ability, and that's where it's crazy when it comes to this YouTube side of things, is I never thought that I'd be sitting down with you, Si. I never imagined I'd be interviewing someone, on their funds, and especially when it comes to the success level that you've seen so far. It really is just amazing. So I do appreciate that. And we'll jump into our couple viewer questions. Number one, we'll see if you can even give us any information. Do we have any new Tapp Alpha ETFs in the works that you can talk about?
Uh, in the works. Can I talk about them? No.
Yeah.
So it's interesting when you actually get funds in motion and are going through the filing process. There's called a blackout period, and so as soon as we're out of that, uh, I will definitely reach out to you and we can kind of dig more into it. But
Amazing.
I like the main, I think, overarching thing that I want to convey is we had one fund for a year, and then we had two, and then now we're starting to grow. But the only reason that we're able to do it is because of smart, educated DIY and retail investors that can understand what's going on in funds and actually put their resources into things that they believe in, that like advisors and folks that have way more process don't have the flexibility to do. So the only reason that I can't talk about funds that don't yet exist that maybe will exist is because of the viewers that sort of kind of watch your channel, and the work that you do to sort of help get the word out there for kind of brand new innovative issuers like us. And just want to say a heartfelt thank you, because it has been honestly the most rewarding professional experience that I've ever had.
Well, I appreciate that. I feel the same way from the other side, where it's nice to have solid funds to talk about. I mean, without a lot of, the good issuers, I'd be kind of stuck. I don't think the channel would do so well showcasing all my losses and whatnot. So that's excellent. All right, excellent. We already touched on our next question, so we'll jump in, which is this is a specific. It's a little bit longer, so I can repeat it if need be. And the viewer asked, all high dividend ETFs declare the amount of distributions in the morning before the X date. Customers know how much dividend they will get to invest more. TSPY announces the amount of the dividend late in the evening. Why is this, and is there a potential to change that?
We do it for a specific reason. So the why behind it is, the distribution percentages that we have and the resources that we have also include the results of the declaration date. So we end up actually or actually publishing what the distribution is just after market close on the declaration date. So that's step one. And then the second half is, there's an absolute number, whatever it is, 30 cents. We do that on declaration date. But the other number that everyone is really interested in is the yield percentage, the distribution rate. Well, the denominator for the distribution rate is the closing price on the ex-div date. So we can't physically um, actually publish a number until after market close on the X date. So that's why the percentage doesn't come out until the next day on X date. So those are the reasons the timing is what it is. Maybe some other funds are, not considering the performance of that same day so they can find what their distribution number is. But for us, we're using every penny in order to inform what we're actually going to distribute, and then we use the actual calculation on X date as soon as possible. So those are the reasons why we have the timing that we.
Amazing. Makes a lot of sense. All right. Our final question is, where can viewers find information about Tapp Alpha, stay up to date on the current news, on distributions and whatnot? Where's the best place to do that?
Come join the Tapp Alpha community. So go to tappalphafunds.com,
I'll
and there's
link
an
this
email
down
box.
below as well for those who want to check out the link.
Perfect. Yeah, come and join, and then just drop your email in the box, and then we put all of our newsletters out. So we have sort of informational content. So like the NAV discussion we had earlier, a lot of blog posts that we write on our company site that's not necessarily fund related. All the Tapp Alpha news, like the first information on new stuff that's happening, distribution information, all those things are available there. And then also on X and LinkedIn. So Tapp Alpha Funds on X and then Tapp Alpha on LinkedIn. Those are all good places to sort of get the social feeds for the stuff that we're doing. But for me and for all the folks that are associated with Tapp Alpha, the conversations are that's the good stuff. So come connect with us. Like we are all ears for ideas and the whys. We'd love to hear the like the stories. Like one advisor, he was like, I'm using both TSPY and TDAQ. He's like, TSPY is helping me pay for my daughter's wedding because of the cash flow that's happening. And I'm like,
Hmm.
that stuff is magic. I love hearing those stories. So the good and the bad, whatever's on your mind, like we love to interact. Please send your ideas our way and stay in the conversation with us because that's the thing that energizes us and keeps us going.
Awesome. Love to hear it. Well, again, thank you so much, Si, for coming on the channel, and we'll have you back as soon as your schedule permits, and we can talk performance and potentially maybe next time a new fund even.
Can't wait. Thank you, Spencer, so much for having me. Great to see you.
Great to see you. I had the No NAV Erosion CEO back on my channel. That is what I call him anyway, Si Katara from Tapp Alpha Funds. You probably have heard of his funds like TSPY and TDAQ that have been performing extremely well. We're going to talk all things weekly dividends, future income products, and the 3-month performance of TDAQ, which has been amazing. So I hope you guys are ready. Let's get into it.